understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Friday, welcome to another episode of the Tech Behind FinTech. Pretty exciting show today. One of my favorite topics to talk about. We're going to get into fraud, and my guest, Kyle Thorton. Kyle, welcome to the show.
Thanks for having me.
Of course. Kyle has an extensive background in fraud and FinTech, so we would love to, we're going to dive into it. The title of today's show, Defending the Future, Strategies to Combat Fraud in FinTech. Let me read Kyle's bio, and then we're going to get into some housekeeping things. Kyle has spent over 10 years fighting financial crime in the FinTech space. After starting in a support role for merchants receiving credit card disputes, he found a knack for uncovering merchant fraud rings based on transactions being processed on their accounts. After moving to the card issuing side of the industry 5 years ago, he has developed a fraud department for over 30 neobanks and leads a team of expert analysts in combating the day-to-day fraud that every FinTech faces. Wow. Sounds pretty exciting, man.
It's fun, for sure.
You have like a superhero outfit in your closet?
I do. It's it just has FF. It's just Fraud Fighter. I put it on every morning, and get to it.
Dude, you're like really fighting crime, man. That's like so cool.
Yeah, it's interesting because working in the industry, you just kind of we're always an afterthought, the fraud side, but like truly stopping financial crime is like what me and my team do every day. That's awesome.
You know what? Basic question before we get into things. How do you define fraud?
Ooh, fraud, I would say, is anybody's attempt to. Oh, how do I not make it circular and say fraud? Anyone's attempt to take something that isn't theirs or doesn't belong to them, I think, is a pretty basic way to describe it. But in the FinTech industry, it's also kind of, doing things that stop other people, so stop normal people from being able to live their day-to-day lives financially, right? Because it's going to impact whatever person is having fraud committed against them.
I mean, 100%. I mean, if we look at, money as a resource, you're literally depriving someone of resources. And I've been just looking at, various crimes to prep for this show. Before we get into it, because a lot of questions, a lot of things I want to cover, let's do some housekeeping stuff. Tech Behind FinTech, we are streaming live from Facebook, LinkedIn, YouTube, Twitch. We also have a stream going from Instagram. Those on Facebook, LinkedIn, YouTube, and Twitch, if you put a comment in, you'll be part of the show. We'll put you on the screen. All comments are welcome. Comments, questions, insights. Love the interaction. Instagram, if you want to go live on, it's pinned to techbehindfintech.com. You will see links to those channels, or if you post a question, we will answer it. It just won't be posted on the show video. So now that housekeeping is over, saw this very interesting stat I want to bring to the screen. We're just going to jump into it, so this is going to be a great conversation. UK firms spend £22,000 each hour fighting fraud, collectively spending 32.4 billion each year on financial crime compliance. FCC. What are your thoughts on those numbers?
Crazy amounts of money. Years ago, I think the normal stat everyone tried to use was it cost, at least on the acquiring side, it was about $3 in cost per $1 of fraud. So man hours, research, talking to these other banks, figuring out where the money is, moving it back. I mean, the costs just stack up because it takes people to do all of these things. And the industry, so combating fraud, it says the UK spends 32 billion pounds a year. The industry to commit that fraud probably spends more money. Because they have to do the same thing, right? For every person like me or people on my team that are trying to recover funds, trying to close these accounts, there's probably two people trying to commit that fraud, right? They work in these farms, they have their own office buildings, they have tons of phones, they're trying to open all these accounts all the time and move this money. And it's its own industry. Like committing fraud is an industry, and the banking side has stopping it. So it's totally reasonable spending that amount of money industry wide, but the fraudsters are probably spending more in order to get those ill-gotten funds.
You know what? It's interesting you say that because we had a guest, a couple of years ago on the show, and they worked for the government at one point in time, and that was something that they said, right? Like what you just alluded to, these criminal organizations, it's literally like a 9 to 5 for some. Like they have hours, they have, sprint cycles, the technology, they're releasing software, whether that's malware. It's a methodical process. This is not like, script kiddies fly by night up in their mom's basement 3 a.m. I mean, this is legit. Like I wake up, they support their families. I go to work. It just happens that it's highly illegal what they're doing, but there is a huge industry geared towards that. And it reminded me of that conversation that you said, what you just said.
Yeah, and it's really crazy because you can see how it happens in real time, right? So we take a pretty standard version of fraud, which is ACH fraud, right? Stolen account, they're transferring money through. They know. So like the fraud side of the industry understands every banking process, right? They know how it all works. They know who is processing what when. They're usually not in the US anyway, so they're also like working during the day. So if you take a normal ACH file, gets processed overnight, and that money is going to be available usually technically at 4 or 5 a.m. a lot of times. It's noon for them. It's 1 p.m. They're just waiting for this money to show up to spend immediately. And then the banks, suddenly there's a return, the money's not there. Like they have all these preparations for extracting that money as soon as possible. They work around the clock, right? They're 3-4 shift kind of people, where they need that money moving as soon as they possibly can. And they have multiple people working on single accounts because you have to, take the account at a traditional FI, Chase, Bank of America, what have you, have a few different FinTech accounts to start laundering that money through to finally get it out through whatever process you choose, whether it be purchasing Apple products, which we've seen, purchasing crypto, which is a huge one for anybody that offers like credit card or debit card crypto on ramping. Like it's huge to move that money through. So they're ready all the time, right? And we're not. Normal person is never ready for it. So
You mentioned two things I want to break down. Number one, using ill-gotten gains to actually purchase Apple products. Can we explore that?
yeah,
So that they'll buy the product in order to then, I guess, resell it somewhere else.
yeah, and
That
what we
becomes like their asset.
Yep, and what we see is it's out of the country a lot of times. I found a really big fraud ring on one of our programs where they were using the Hong Kong Apple Store, purchasing in person. It wasn't even like online. They were moving all of this money through these accounts and then in person buying Apple products in Hong Kong, usually to resell them. It happens in the US too, though. So what they'll do is buy thousands of dollars worth of iPhones and MacBooks and get them out of the country because all of those things are always going to be more expensive somewhere else. So it's even moved from, this kind of nebulous idea of money in general and just moving and it's on a ledger and everything to physical product purchasing and making money off that because it looks almost more legitimate when you're buying something to the fraudster so they can fly under the radar longer, right? If I see an account and money's just moving constantly, it's pretty suspicious and it's going to get watched. But if you see an account new fintech, they move in $5,000, they buy a MacBook. I mean, that's not unreasonable, right? It's not crazy to think that somebody wants a new laptop and they're using their new card to do it. But then you start seeing that, well, this fintech actually has like 50 new accounts and they're all buying new laptops. And that's really odd because they're all from the same Apple store. And what are the odds statistically that my fintech that launched 2 weeks ago has 50 brand new people who all live in the exact same place, who are all doing the exact same thing?
Let's pull that thread. So essentially, it's a fraud ring. They create a new fintech startup, right? That fintech startup is some sort of shell, just some sort of camouflage organization, so that they can launder their ill-gotten gains. Is that what we're
Well,
saying, or
no,
what?
well, actually, the worst part of it is that they're not launching their own fintech, which would be it's harder for them, right? Because you'd have to find a bank partner, you have to do all these things. It's worse because you're actually attacking a fintech that is new or already existing, which means you're harming that business, right? If they were launching their own fintech and doing it, then they're just being bad. But now they're actually impacting these brand new fintechs where there's not a ton of float for those fintechs to be losing all of this money. So they'll find a fintech that has just launched or is a few months old and launder that money that way.
I want to definitely dive into it, because that
Oh,
directly impacts the community that we talk to and we service. So I just went live with a new fintech, right? It was startup under 10 people. We're relative. No, you know what? Let's even get a little bit more garagey. 5 people, right?
mhm, mhm.
We just launched it. We opened up our bank account. Describe what happens now. Like, how does that? How do they take control? From what you've seen, how do they take control of our accounts, or how do they camouflage as us? How does that work?
So as the fintech, you're generally pretty safe, right? As the company as a whole, in terms of your business money. So like you have an FBO at the bank, you have an operating account, your actual funding is good, but what's going to happen is I come in, I have a stolen identity, right? I sign up as John Smith. I have all of his information. Everyone's info's out there. It can be purchased super cheap. I have a really interesting story about how easy it is to get that we can jump into. But what happens is I have a stolen Chase account.
I'm sorry. I want to break it down so everybody can understand. John Smith is an officer in this fintech, correct?
John Smith is a customer. So
Okay,
on the
okay, customer.
business side, I would kind of separate it. The business side, everyone's fine, right? We'll say this is
Good.
a legitimate fintech that you launched, right?
Yes.
I come in third party, I live in Russia. I have an identity that I purchased. He's a United States citizen named John Smith. I also have access to his Chase bank account. I
Right.
have all of his info. I transfer $10,000 in via ACH, and I can do multiple things now in a very short period of time. I can purchase crypto. I can go buy Apple products. I can transfer it to another fintech. I can put it through a P2P system. But my goal is to get money from Chase onto your platform and then off as soon as possible, because the real John Smith is obviously going to notice that $10,000 is missing from his account. He's going to contact Chase. He's going to say, I didn't authorize this ACH transfer. And Chase is going to send a return code. It's going to be an R10. This wasn't authorized by our user. And that $10,000 that was at the fintech that got spent is going to get pulled back by Chase. So now you are minus 10K at the fintech. So say this was your only customer, he brought in 10,000, he spent all of it, but now Chase is saying that's our $10,000 that wasn't authorized, and you are now minus $10,000, and that has to be recovered somehow. Usually, unfortunately, it has to get written off. There's very few times that you can actually get that money back, especially if the vector was purchases of some kind. It's very hard to go back and charge those back and say they weren't legitimate, because the process that exists in the industry is not that great to show all this proof, like this definitely wasn't him, this definitely wasn't this. Acquiring banks don't focus that much on it.
But you know, from the fintech perspective, right? Let's get into KYC.
Hmm.
You know,
Oh,
for those who
totally.
don't know your customer. Let's get into AML practices, right?
Hmm.
If those steps were carried out effectively, how can this fake John Smith have an account, be able to do that?
Totally. So I'll start this conversation with the industry for the past 5 years or so has been hyper focused on zero friction onboarding, right? Fintechs need as many customers as they can get. That's how they get funding. So they need as many people onboarding as quickly as possible. That's great for fintechs to onboard people. KYC as a process, know your customer, verifies four things: name, date of birth, social security number, address. That's it. That's all KYC technically has to look at. That information is all purchasable online. Every American's information was stolen years ago. A lot of identities are sitting dormant. Um, that part is very easy to pass, which is why there is another layer that has gotten much more popular in the past few years, which is great, which is the fraud layer of onboarding. Fraud looks at a couple things. One, it looks at your KYC data as well to kind of compare it to what it sees. And then the other thing I like to call it is your digital identity. Things that should be unique to you. Things like your email address, your phone number, your device information. So what we see a lot is these fraudsters using the same phone over and over and over, right? So if you're at a fintech and you can see, wow, 10 people signed up with the exact same iPhone because there's a unique fingerprint for the device. That's odd. People shouldn't be sharing iPhones on their banking app. How could they possibly consistently access it? What am I going to call my friend and be like, hey, can you bring your phone over so I can log into my bank account? So we see those things as shared information that shouldn't be shared. Same as a social. My social is not your social. My iPhone is not your iPhone. We should be unique in those ways. So there's a fraud layer that we have begun implementing quite heavily in the industry, which does introduce some friction, but helps identify these people that may have a stolen identity that can pass KYC because the information's real, but they're not passing these fraud checks because they're sharing information that they shouldn't be sharing.
So it looks like, I mean, one of the biggest takeaways from what you just said, I mean, we acknowledge, right? Look, to get funding, you know, your startup, you want to get, you know, increase your the number of users. I just thought about a story that's going on right now with that company called Frank and JP Morgan suing them, right, for the fake users. So obviously having users is a big deal. It can lead to acquisition, it can lead to more funding, it can lead to everything. What we've been seeing, based on what you're saying, right? The no friction onboarding. So that's eliminating a lot of more in depth, like, okay, KYC, you listed four elements, but the other layer, anything that can add a little bit more friction that can possibly delay the onboarding, a lot of these fintechs have basically bypassed for the golden ticket, right? To get more
Yeah.
customers. But then we're seeing though the losses are. I mean, even what you can, I think it was in U.S. It was like a 51 million number. I had it in the show notes. There's 22,000 a year in fighting financial crimes. So I mean, I read that the average fintech spent like 51 million. I mean, depending on their revenue, obviously. So it's a very it's very interesting. It's like which would you rather, like how, and you know, for me and from a cybersecurity side, I'm of course interested in that. You know, you don't want to impact the business, right? Because you know you could be putting all these guardrails and it becomes an unusable product. And it's like, dude, what are you doing? But at the same token, you want to secure the business. So it's a fine line.
Yeah, and that's for our company, that's the line I toe every day for all of these new fintechs is how can we be risk averse but not impact your business so heavily that you can't grow, right? Because for us, fraud is an afterthought for the whole industry, really. Like even huge financial institutions, it's just this small piece of their business that because it's not revenue and it costs money to combat fraud, companies aren't that worried about it. But for very small fintechs that don't have a lot of money coming in, a $10,000 loss in your first few months is huge, right? That's going to impact your business. It's going to shut your fintech down. So it's trying to get, the position I've taken recently for these fintechs is, hey, for the first 3 months, let us be more careful than we would, right? I want to be safe with the people that we're bringing on because I don't want to lead you to losses immediately, and we can expand what your business looks like as time goes on, and we have these controls in place. Because what happens a lot of times is a fintech says, "This is my customer base. This is who I'm going to focus on." Almost no fintech at the beginning follows that, right? Everyone has a really great idea and they're like, this is exactly my target market. And it almost never is. So we try and say, hey, let's take a couple months. Let's see what your user base really looks like. And then we can conform all these new rules around that. So we understand how people are moving their money, what makes sense. Because things like AML, it's not one size fits all, right? A business fintech that focuses on small businesses is not the same as a fintech that focuses on 18 to 24-year-olds building their credit, right? The money being spent there is totally different. So you can't just say, here's what our money movement rule looks like, right? Because a small business might need to move 60, 70, $80,000 a month, while me, I'm moving $2,000 a month and spending it. So we try and conform the rules that exist for these fintechs to those fintechs instead of saying, here's the rules that exist. You're going to follow these, and it could or could not harm your business. We don't know yet.
Question for you: What are the primary types of frauds that fintechs companies usually encounter?
So there's a couple, and they usually interlink, right? For the past few years, the biggest thing in the industry that we've seen is what is called synthetic identities, which are KYC data and identity that has been changed just a little bit to become a new identity. So there's something called first party synthetic identity. So I take all of my KYC information and I start signing up, but I change my social security number by one digit, right? And a few years back, I think they were called credit protection numbers. There was a little like scam on the internet going around that were telling people, hey, if your credit's bad, you can use this new uh, 10-digit number, 9-digit number. So essentially the length of a social. Just create one and use that over and over and over, and use your other information too. So Kyle Thornton, my address, my birth date, but use a 9-digit number that's not my social. And if you use it enough, you'll be able to open accounts with this new social, and it helps your credit score. Well, what it was doing is, 4 or 5 years ago, was blasting credit agencies with credit bureaus with new identities, right? My identity is my normal social security number. But what's happening is Experian, TransUnion, they see my information in this other, so what they would consider a social, because it's 9 digits, coming through over and over. And they say, well, that's odd. They don't have a credit file, but they keep using this information. So they must be a real person. Why would they keep doing this? And suddenly I have a brand new credit file created for me and all my information, except my social security number is different. So it was a huge problem had the past couple of years where you could just change a couple pieces of that information, whether it be your birth date, whether it be your social, and you would get a new credit header, and you would be able to onboard places as me, but not technically me. It was a synthetic me. It was me, but a little bit of the information was different.
Wow.
So that has luckily, the industry has been fighting that very hard. Like, it's not solved yet, but it has been, nowhere near as huge of an issue. 2018, 2019, it was a massive problem, and the industry wide has been doing a lot to combat it, but it's not gone. So that's synthetic is probably a really big problem in terms of this is a type of fraud. The next is ACH fraud, which they almost always go hand in hand. So ACH fraud is um, I transfer money to a fintech. I use the effect of an ACH pull. So I go in my fintech app. I say I want to deposit $500. They go to my other financial institution and pull that money through. I am going to do one of a multitude of things. Either I don't have the money available in the other account, or I'm going to tell my bank that I didn't make that transfer. Both of these, in effect, will take that money back from the fintech, but my goal is to spend that money immediately as soon as it gets into my account, as a first party. And then first party and third party are going to be two different things. So first party, me am committing everything. Third party, you stole my identity and you're doing all these things. So they're effectively the same, except the person doing it. But I'm going to take that money, I'm going to spend it, the account's going to go negative, I'm going to disappear. I'm never going to interact with it again. It's a debit program, it's not getting reported anywhere, right? They're not going to send anything to my credit agency. They're not going to send it to collections most of the time because a new fintech, that's costly. So they can't do a lot about it, besides go to the other bank that the money went to and said, hey, we're pretty sure this was fraud. Can we have it back? Those are the biggest ones.
I want to drill down on the ACH one because you said I want to drill down on first party and third party and what you've seen. So from the first party perspective, this is now the individual basically committing fraud. This is not a criminal organization, right? This is just somebody who sees an opportunity to make extra money and commits this fraud. Now we have the third party, which are the criminal organizations, organized crime, criminal rings, right? Percentage wise, how many first party offenders do you see taking advantage of these fintechs?
It's actually been rising in the past few years. These days, I would probably put it at maybe 70-30 third party versus first party.
Oh, wow.
For a long time, and you may have heard this 2015, 2016, where everyone was suddenly saying like, hey, why don't you just charge it back? Oh, you bought something and you didn't like it, charge it back. That's first party fraud. That's a crime. So if you buy something and you don't like it and you decide you're not going to, I'm way out of my return policy. Oh, just call the bank, charge it back. They'll get you your money back. That's illegal. That's first party fraud. That's first party chargeback fraud.
I'm laughing because this guy, basketball player, Gilbert Arenas, right? It was a story, right? So he goes to strip clubs, right? Charges everything from it's a fintech show. We're not going to go crazy, but everything you could possibly think of, he charges, right?
Mm-hmm.
And then the next day he calls, hey, something happened to my card. I don't know. They put all these legal transactions, calls Amex up. They refund him his $75,000. So, or whatever. So you figure if you're spending anywhere from 50 to 75K in a strip club, it's a wild night. So he gets the money back, but he actually admitted this in an interview. So it's like you're actually confessing to committing fraud.
And it's crazy because like your normal person doesn't think that they're just like, oh, it's not a crime. This isn't illegal. It is a crime. It's a financial crime. But who's going to do anything about it? At most, Amex is going to go, although Amex is incredible as a card member. If anybody needs a card, always get an Amex and always use it. But the worst that can happen to him, Amex is going to charge him his $75,000 and put it back on his account. But he's not going to get in trouble anywhere, which I think is the problem that has arisen in the industry. Is there's no one to tell these people what you're doing is something you're not allowed to do. Now, recently, Nacha did change their rules around ACH fraud reports, which is really good for the industry. Previously,
sorry, Kyle, can you explain what Nacha is?
Nacha is the I don't know the exact piece of the acronym, but they're the people that essentially created and run ACH. They make all the rules for ACH in the United States. But what happened is there's all these return codes. There's like 30 return codes for something happened with this transfer. The bank is going to send a return code back to pull the money. One of those is an R10. This is I told my institution I did not authorize a transaction. So that can just be anything. Any ACH that comes through, I can call Chase. That wasn't me. Previously, there was no problems. I go into my fintech, I pull $5,000, I spend it, I go to Chase. Hey, I didn't do this. They give me my $5,000 back. I just doubled my money in less than a day. Now, Nacha has given guidance to institutions to say, when somebody files a fraud report, they now need, and not every institution's following this yet, but not just saying, what they should be doing is signing an affidavit that says, this was truly fraud. I am not perjuring myself and I am not committing a crime. So this is very good for the industry because it might scare off that potential person that is going to try for their first time to commit fraud. And when they go to their bank and they say, oh, that wasn't me, and the bank says, okay, well, you need to sign this document that legally says this wasn't you. And if we find out it was, it's going to be bad. That's the kinds of things we need in this industry, right? Because we need to, even if it's just 30% of fraud committed, whatever the number is currently, even if it's 30% are first party fraud, if we can keep reducing that number, that's good. It doesn't matter what it drops to as long as it's going down. So if we can take that small part of the fraud industry and get rid of it by scaring people that are attempting to be criminals accidentally or purposefully, that helps all of us, right? If we can cut any amount out.
So, there's this term that's used called a victimless crime. And so from a first point perspective, these things are done. But can we, or do you know, like, what's the greater impact that this is having on the industry, on the economy, on business, so forth?
Yeah, and it certainly isn't victimless, right? Like, I think a lot of people think it is, because for a long time we said, oh, well, JP Morgan Chase is worth $1 trillion. Who cares if they lose $5,000 or $10,000? Like, what's it going to hurt? But when we bring these fintechs in, where these fintechs have $100,000 on the books, well, if you steal $10,000, that's 10% of their money is gone. They have employees. They might be banking people that are in a banking desert. We have a great founder that's the focus for her program. And now those people could end up without a bank because that program shuts down because of too many losses. These community banks, so a lot of these fintechs banked by community banking partners, smaller banks, 2 or 3 branches, not billions and billions on their books. They have $30 million, $40 million as a bank. Yeah, that's a good amount of money, but in the grand scheme, it's not. If these fintechs start shutting down, auditors start coming in and regulators start coming in and they say, why are you getting all this fraud on all of your fintechs specifically? And now that bank is getting consent orders and they're having to shut down. And then that bank has core customers in their town. And now those people are impacted by the bank not being able to bank people anymore. So when somebody goes to think to themselves, this is a victimless crime, I'm just getting some of my money back, it's not a big deal because these are all big banks involved and it doesn't matter. But truly, that can snowball into a town not having a bank. And I know that sounds extreme, but really it could happen. Like, we've seen over the past 6 months, multiple banks get shut down, bought, and some weren't based on fintech, but some were. We see consent orders go out. We see, stop onboarding go out. So the regulators are focusing on these things. So when fintechs are experiencing fraud and crime, it impacts the fintech, it impacts the bank that fintech is banking with, and it starts to impact the industry, because if multiple fintechs are having this problem and multiple community banks start having this problem, regulators are going to come down harder. They're going to create more and more rules that are going to impact fintech, which the point of the industry is to be pretty lightweight and not have to deal with 100% of the things that traditional financial institutions do. But if we don't take all these steps to stop that crime, then everything is just going to come down. There's going to be all these rules that say, all right, now you're essentially going to be treated as a bank. This is going to be worse for everybody, really. The industry will just become banking and not fintech.
I absolutely love that breakdown. And I love all the angles you just covered. Brilliant. Question now. How would you recommend building a strong risk management framework to proactively identify and potential fraud threats? So this is for that. So basically looking for advice for fintechs moving forward. I know we talked about KYC. I know we talked about the fraud component to it. Anything in addition?
Yeah, totally. And I think to even start from the very start, having a robust onboarding process, right? You need KYC. you should also be using some sort of fraud vendor up front as well before you even let somebody onto your books, right? You should be comparing that digital identity information, phone numbers, emails, device information. Compare all of that before you bring somebody on. Then, once somebody is on, something a lot of fintechs don't do for a period of time is in-depth transaction monitoring because it's difficult, right? So monitoring transactions is a huge effort. There's a lot of good platforms out there that use AI and ML models to do it. But what happens is fintechs can't catch all of these bad transactions because they only have 5 employees. And their first employees are the founders, an engineer, and someone in customer support. There's not somebody that's an expert there in compliance to be looking at potential AML or potential fraud. And they don't really know what they're looking at it because it's not their job. They haven't been doing it for years, right? If I brought a normal customer service agent and said, here's a list of 1,000 transactions, can you tell me which ones are potentially bad? It would be like German to them, right? Because it's not something they do every day. Versus if you take a fraud analyst or a compliance analyst and do the same thing, they've experienced it their whole career and they can start picking out transactions that are out of the ordinary for that user base, for that user specifically, and these individual things. And then there's vendors that also enhance that and give you real like data around it. But for the industry, just for any fintech, vendors are amazing. AI is great. ML is great. You will never kill the role of an analyst because there are certain things that a computer simply cannot see. Um, Automating everything is generally worse without any human review because a computer will make decisions based on only what it's seen before and generally cannot make a new decision, right? If you have somebody that only spends $100 a week and then they go to make their first big purchase and it's $2,000, a lot of things are going to catch that up. If you've ever gotten a text from one of your credit cards, like, "Hey, we noticed a purchase that was way out of the ordinary for you," a fintech can't just send a text, right? They have to introduce real friction. They probably have to suspend the account if it's all automated. So having an analyst there to say, "I understand what these transactions look like," even if they're just using that enhanced vendor data, that's what's important. Once you're live, right? So you want to make sure that when you have people on the platform, fintech is about moving money and spending money. You want to track how that money works on your platform. And that's what's going to keep most fintechs safe.
Excellent. Thank you. What I also noticed some stuff, right? The startup side of things are getting, it's a lot of funding going towards fraud detection startups. A couple from MoonSense bags 4.2 million seed funding. Financial crime risk management solution Quantified raises 23 million. A fraud and bot management platform, Datadome, collects 42 million. Is similar to what you're seeing in terms of, you mentioned a lot of AI tools that could be used for this effort. Are you seeing similar in terms of startups in the industry coming to the forefront and raising tons of money in this space?
Yeah, and I find it really good that these fraud platforms are receiving funding because again, a couple years ago even VCs, and I don't want to generalize here to say VCs in general don't care, but I have interacted with VCs for companies that I have launched, fintechs that I have been a part of their launch, where flat out they said, I don't care about fraud. I care about the amount of people coming onto the platform and spending money. And that is how we are going to keep funding you. Well, when they experienced tons of fraud because they wanted to continue onboarding whoever they wanted, suddenly they were losing money and their VC chose not to invest more money because they were losing too much money. So the industry has been like, oh, fraud is this thing that happens, do a little bit to resolve it. But now the industry is understanding like fraud impacts all of us in the industry. It's critical to stop. And there's a lot of it's great that there's so many different startups because there's plenty of room for all of these startups to come in and do their niche fraud piece to stop this crime, because everyone now understands how important it is to stop the loss of money to keep these fintechs alive. If you invest $10 million in a neobank, if they lose all their money due to fraud, well, your investment was not right. Versus these fraud platforms coming in, getting investments, because those VCs now know, okay, well, I have to protect my other neobank investments by having this fraud vendor come into the space.
Listen, I can stay. You're one of those guests, one of these guests that I can stay on and have an all day conversation with you. Because I mean, as you're talking, I'm thinking of more questions and like, wow. You know what? I'm gonna say you're a friend of the show. You're somebody I want to bring back on because there's so many different avenues I like to dive into with you around this topic of fraud, and I just think it's just so much information. Definitely appreciate the tips for fintechs in terms of that you gave. I think that's a real that's really informative. Even for me on the cybersecurity side, hearing that it's really good. Um, Before we take off, you had a story around your interactions with the FBI, and I wanted you to talk about that prior to us. I think it's interesting. So, can you elaborate on your interactions with them?
Yeah. So a couple years back, I had met somebody in the FBI's financial crimes unit, and had just been talking about the things that I see. Right. What can I do? Because it can be frustrating in my position in the industry because I don't really have power. Right. I can't really stop anything except protect my own fintechs. Um,
But what about your superhero suit?
my superhero cert, unfortunately, doesn't let me fly, and I don't have, like telepathic communication. But those would be great things. It just looks really cool, and the spandex is very accentuating. Um, but for me, if I close an account because I know it's fraudulent, that's all there is, and I can focus on all my fintechs, and I can give some consortium data out to the industry. But if I know it's a fraud ring, there's really not a lot. I can just keep whacking the mole as soon as it comes out. So I was talking to the FBI and was saying, "Hey, this is my struggle in the industry. What can I do with you guys? What exists for me to be able to tell you things?" They said, "Here's how you can contact us, and here's how you can send us what you would think would be a large case." Now, the interesting thing with the government is they want big cases, right? They want to, if we're spending tax dollars to pay these people, we want to make sure that we're really impacting the industry in a severely positive way. So even though to you and I, $500,000 is a lot of money, right? No,
Yes, sir.
the regular person, $500,000 is huge. The FBI is like, "That's great. We're glad you stopped $500,000 from being stolen. Can you link it to anything else?" And you're like, "No, it was just this small ring." And they're like, "Okay, thanks for closing it." What they want is big international fraud rings, which is perfect. But you have to be able to show, like, here's all the data I have, and I think it's a loss. They could be stealing 2, 3, 4, 5 million dollars. That's when it really matters to the government because they're going to put all these assets. They're going to go to different countries and ask for information. They're connecting all of these other industries internationally. So for the big cases, they're happy to like get as much data as they can and go prosecute. They don't tell you afterwards anything that happens. So if you go to them with like a $10 million fraud ring, you're like, I did all this work. Look at all this. I can prove to you that there's a $10 million fraud ring. They're like, perfect. We'll take it from here. You'll never hear about it again. There might be some sort of like FBI release somewhere that's like, oh, we arrested X number of people for committing a crime, but you have to hope that it happened to be yours. They never send you an email. It's like, "Thanks for the tip. We really knocked it out in the park in this one. This was because of all the work you did." They just pat each other on the back, which is perfectly fine. As long as it's getting stopped, that's great. But they don't say, "Hey, it was you. You did this. It was all us." That's kind of how
That,
they do it.
yeah, I mean that's so not cool though. But
Yeah.
but you still doing your part. I mean, I think by doing that you earned a suit. You definitely earned a superhero suit.
Yeah.
But it would be cool if you can trace that back to work that you've done. Kyle, man, you've been awesome. We have before we close out, we have some comments from the audience. Asif Haidar, Nnamdi Osuagwu, admire your consistency and persistency for knowledge. Share, thank you very much. And we also appreciate our guest. Another comment by Asif, good concentration to learn from. Thank you very much for viewing it in the comments. Love it. Thank you very much, Asif. Kyle, once again, you're a friend of the show. I'm going to coordinate schedules with you in the future. Bring you back on, especially when like big news events happen. I want to acknowledge what you do, so I want to bring you on so we can break it down and talk through it. Please let the audience know how they can find you and so forth.
Yeah, Kyle Thorton on LinkedIn. I work for iLEX Consulting Group LLC. We are a pretty boutique firm that focuses on launching fintechs. So if you are a founder with an idea and you don't know where to go from there, you don't know how to find the right partners, we're here. You can reach out to me at kyle@ilexgroupllc.com. That's ILEX. And we're here. We'll help you get launched. Joyce has been here for 10 years. She's our owner. She's been a part of almost 50 fintechs now. And you, as an audience, have likely heard of one of our programs. We touch the industry a lot from every angle of getting you launched. So find a bank, find a processor, find a card embosser, get your KYC and fraud vendors in place, especially your fraud vendors. We do all of that, and we can help you once you launch too. Like I said, I run a team of analysts every day to stop that crime. Perfect, and thanks for throwing our website right there in the chat, ilexgroup.io, and then you can reach out to us.
Your CEO Joyce, she's been a friend of the show. She's been on a few times. She was here for our 100th episode group when we did it. So definitely look what you guys do. I just want to put the website up so people can see that. So now it's part of the video show forever. Kyle, thank you very much. So we're here every Friday, 12 p.m. Thank you for viewing the show today. Once again, I'm your host, Nnamdi Osuagwu. You can catch us back next week for another live episode of the Tech Behind FinTech. And you guys have a great weekend. Any questions, always feel free to shout us out. By the way, this episode is sponsored by Strategic Generation, boutique consulting firm specializing in cybersecurity, SOC 2, and pen testing. In the show notes, if you want to book an appointment to learn more, definitely follow up for pen testing questions and SOC 2 related. Thank you very much. Have a great weekend. Kyle, you were awesome. Looking forward to having you on in the future.
Looking forward to be back.
Cheers.
Have a good one.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.